I think that actually a lot of people are still expecting that the good growth that we're seeing this year is just a flash in the pan and isn't really going to persist into 2019 and 2020. And so I actually think that we actually have a number of factors at work here. If you look at flows as far as into mutual funds, people really aren't going all that crazy into equities right now. You look at emerging markets underperforming, unless you're getting some of the confirming evidence from the economic data that you're seeing a slowing. I don't think that there's really a good basis for saying that any dip that we get isn't more of a buying opportunity than anything. In our mid-year insights piece that we just put out, we talk about how people need to expand their search for growth instead of just looking at what has worked in the past, say the FANG names. You might want to expand your search for growth, and you also need to maybe adjust your expectations for a longer economic cycle as opposed to just thinking that it's going to end just as a matter of time, or just simply because we saw a slight slowdown in the PMI numbers. Just this morning we saw the PMI numbers out of Europe, I think catching a lot of people off guard.
People to get in here.
Well, well, number one, though, the PMI numbers in Europe are actually rolling over. And then as far as individual exposure to equities, Ned Davis Research put out a very interesting chart this week. Individual ownership is at the highest level we've seen since 2007 and 1968. Both were very important market tops.
Highest level of ownership. In other words, there's so many people in the market that's often a contrarian signal.
Now, that could be ETFs. It could be
ETFs. It could be 401ks. It's a lot of
it never
matters. The methodology?
No, of course not.
You know, Jim, what's interesting about this losing streak here is that it started with Jerome Powell. It started with the Fed meeting. And this whole notion that, well, first of all, we know how many rate hikes are coming, or we think we know this year, and also that there is no put by the Federal Reserve and that they don't care what's going on in other parts of the world when it comes to our economy and what they do with monetary policy. I mean, do you think that we're really focused here and looking at what monetary policy will do and how it could sort of derail what we've got in our hands here?
Well, you know, I think that what's been interesting with the Fed is the Fed's been tightening in this cycle against the backdrop of, you know, rapidly accelerating growth, the synchronization of the globe, incredible surge in earnings, tax cut induced, but nonetheless a big surge. What happens to the Fed and the market's reaction if the economy slows down a little bit in the second half, not recesses, but just slows down? Let's say it goes back to 2.5% growth rate, and the globe is already showing some signs of doing that already, and yet at 2.5% growth with 3.8% unemployment, you'd still get wage pressures, you'd still get CPI pressures. That really puts the Fed in the box in a way that we haven't seen yet. Do they continue to tighten even though growth is slowed? And if they don't tighten, what does the bond vigilante do with that when inflation numbers are still going up? The dollar's been rising for the last couple of months. That's been holding down commodity prices. Another thing that might start showing up today is the dollar maybe is peaking and oil starts taking off again.
Right.
Imagine if oil breaks back to 80 in the second half and puts that Fed in a real box.
Right.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.